Santa rally is here. And it's been delivering more than anyone would have expected. And while for most, Santa is a fluffy old man dressed in red, for U.S. investors, he comes in the form of a well-dressed and well-articulated middle-aged man, by the name of Jerome Powell. People have long been debating. Is Powell the new Arthur Burns? Or the new Paul Volcker? Has the Fed guided the U.S. economy to the softest of all soft landings? During the last FOMC meeting of the year, the Federal Reserve decided to hold rates unchanged, but decided to hint at 3 rate cuts in 2024. And ever since, markets have been unstoppable. Let's take a quick look at the positives. 1. Inflation has been steadily falling. With headline CPI at target, but with core CPI still running at about 4% on an annualized rate, you could argue that Fed's job is not yet over. However, the downwards direction is clear, that chapter is almost closed. 2. Fed has acknowledged that waiting for CPI to read 2% might be too late, and at that point recession might be unavoidable, so the central bank is clearly forward-looking, and not reactive. Team, it's transitory, no more. 3. U.S. consumer remains resilient. U.S. retail sales have again surprised positively in November. Most of the components have been on the rise, and the biggest laggard remains gas prices, which makes sense, considering energy prices have gone down. This, coupled with positive earnings growth over the last 12 months, proves the U.S. economy is still strong, but could also be a reason to worry, as it could fuel a second wave of inflation. Lastly, having the U.S. economy evade entering an official recession so far, in spite of tight monetary conditions, while inflation is cooling down, means that if anything were to break, the Fed has a comfortable cushion to intervene by slashing interest rates. Regardless, we're not out of the woods, yet. Although still historically low, unemployment is slowly ticking up. November data was a breath of air, but not enough to declare victory. Over the last months, both coincident and leading employment indicators follow the patterns of previous pre-recessionary periods. It might be a matter of time until the pandemic labor hoarding unwinds. Housing activity literally fell off a cliff, with the median price of new home down 17% since the peak of 2022. That's a negative record only second to, you guessed it, the 2008 housing market crash. This decline is driven by an oversupply for home builders, and looking back in history, periods where excessive inventory put downwards pressure on home prices also coincide with the onset of recessions. Credit conditions in the U.S. have been anything but loose in the past 2 years and still continue to be for the time being, in particular for those that rely on debt, SMEs and big portion of the general public. After a decade of no interest rates, having to now refinance at such high rates will be a big hit for a lot of economic participants. Also, couple this with low savings rates, and you end up with higher delinquency rates and ultimately, higher default rates. There is also the risk that inflation could pick up again. With a somewhat resilient labor market and not enough cooling down in consumer behavior, many fear that we might be in for a 1970s replay. 2024 is also election year, so both parties might be adding fuel to the inflation fire in their pursuit of votes. Even more so, the Inflation Reduction Act has so far been counterproductive in the inflation fight, and the push to decouple from China is again adding price pressure. Since the Fed started their hiking crusade, economy has been under severe stress. The Conference Board Leading Economic Index tracks a series of economic data points and acts as one of the best proxies to get an indication of the current state of the economy. It also gives us an idea on where things might be heading towards. As per October, this indicator has been contracting for 19 straight months, with only the 2008 and 1974 recession seeing longer streaks. Going forward, there are 2 main things we need to keep in mind. History shows us that recessions occur between 12 and 24 months after the yield curve inverts. We're now at month 17, Q1 2024 will be critical. BTFP, a special program designed to help banks under stress, is due to expire in March. If this program does not get extended, and banks will be forced to sell their assets to raise capital, while unrealized losses make up 30% of their equity capital, the markets could be in for a ride. So, the question remains: is this apparent pivot the seal of the victory for the Fed, or is it just the calm before the storm?